Okay, chapter 14, chargeable gains for companies. Taxation of capital gains on individuals is dealt with in depth at chapter 16. So we're going to look at them shortly. So slightly confusing, I suppose, in that we're going to look at a comparison of the two before we even looked at individuals. But hey, here we go. They are similar, but they're also different. So companies, what do? Well, with capital gains, they pay corporation tax on the chargeable gains because it's part of profits chargeable to corporation tax. Companies do not receive an annual exemption. Individuals receive an annual exemption, which is 10,000, something like 10,600. Companies do receive indexation allowance, which is the effect of inflation, and they can match shares slightly differently. Individuals do not receive indexation allowance, and I say the share matching rules are slightly different. Chargeable gains pro forma for companies is you take the disposal proceeds less incidental cost of disposal, gives you your net proceeds, less allowable expenditure, i.e. what it cost, plus enhancements, that sort of thing, gives you unindexed gain. Indexation allowance, chargeable gain loss thereafter, depending on the percentage. Indexation allowance, as I say, gives the company some relief for the effect of inflation. Because at the end of the day, something's worth something today more than 20 years ago simply because of the time value of money. Indexation allowance is the cost of the asset times the movement in the retail price index. A little formula that's given. Share matching rules for companies. When shares in a company are sold, the calculation needs to identify which shares were sold. The shares sold are matched with the following purchases in this order: shares acquired on the same day, shares acquired in the 9 days before the sale, and shares in the same pool, which is the section 104 pool and the FA85 pool, which is basically based on dates. Very small point, but you'll see that in the detailed notes in the book. Doesn't often come up in exams, so not key for this. So I'm going to move on to the next chapter. Chapter 15, corporate groups and overseas tax issues. Corporate groups. When a group of companies exists, there are a number of relationships that you need to be aware of. Associated companies, from your accounting days and rules, is 50% control. Same rule here applies for tax. What you also need to be aware of though for tax paper is group relief. Only applies if you've got 75% control. What is group relief? Group relief is where one company makes a loss in a group and one makes a profit, and you can offset one against the other. Makes sense, they're in the same common control. Definition of associate companies, well, it's one controls the other, or both are controlled by another company or individual. So you can control 2 or more companies and they are going to be associated. So it's good news for group relief if one's making a profit, one's making a loss, and it's more than 75%. Bad news is the upper and lower limits to determine how high the rate of tax is going to be for corporation tax is divided by the number of associated companies. So this point of view, it's not too good news having too many associated companies. So if A Limited owns 65% of B Limited, then the number of associated companies is 2, and the 750 becomes the upper and 150 becomes the lower limit for profits chargeable corporation tax. Any dividends between associate companies are not treated as FII for the purposes of calculating a company's profit. Okay. And only one annual investment of 100,000 is available for the group. It's not per entity. So if you're an associate company, you've got to remember that. Group loss relief. Group, as I say, you've got to, one owns 75% of the other. Both are 75% subsidiaries of a third. For subsidiaries to be included in the group relief group, then top companies should own at least 75% of the subsidiary. Implications of being part of a group relief are, well, as I said, I've already hinted, the trade and losses of one company may be surrendered, given to a company that's making profits. Which one would you do it? Well, you clearly surrender your losses in the following order. To companies that are paying tax in the marginal relief band, because actually that's the highest rate of tax, where financial year 2008 to 2010 it was 29.75%, and financial year 2011 it was 27.5%, so certainly it's higher than the lower rate. You would then surrender to companies that are paying tax at the full rate of 28%, later reduced to 26%, and then you'd offset it against, if you'd done all that and you still had more losses left over, you would then offset them to companies that are paying tax at the small companies rate of 21%, which it was until 2011 when it became 20%. Overseas issues, the big picture. Overseas dividend income is exempt from corporation tax. You do not pay tax on overseas dividend income. If a UK company receives foreign income such as overseas branch income, it will be included within profits chargeable corporation tax. It will therefore be liable to both UK and foreign tax. The company will be eligible for double tax relief. What is double tax relief? Well, it basically, you're able to offset against your UK tax liability the lower of UK on foreign income, and that's the UK tax suffered on the foreign income, and the overseas tax suffered itself. You can offset the lower of. And that's the end of that chapter. So, yeah, end of that chapter. See you in the next video.